In the realm of financial markets, there are numerous indicators and benchmarks that professionals and amateurs alike utilize to gauge the health and direction of economies. Most are familiar with terms like GDP growth, inflation rate, and unemployment figures. But there's an alternative metric, often less spotlighted, that provides a unique lens to view the stock market's real value, the Dow-Gold ratio. This essay delves into the intricacies of this ratio, its historical context, and its implications in today's market scenario. When one tunes into a financial news channel, the Dow Jones Industrial Average's performance, alongside other prominent stock indices, is typically displayed prominently. But what if this widely accepted measure of stock market health was merely scratching the surface of a deeper, more profound truth? Enter the Dow-Gold ratio, a concept that has been historically significant in understanding the relative value of stocks to gold. At its core, the Dow-Gold ratio is a simple comparative tool. It calculates the ratio of the Dow Jones Industrial Average, a key stock market index, to the price of an ounce of gold. The result is a figure that conveys how many ounces of gold it would take to buy the Dow. Over time, this ratio has presented a stark contrast to the story that absolute stock prices tell. To understand the importance of the Dow-Gold ratio, it's essential to look back at its historical trajectory. For instance, in 1929, the ratio stood at a staggering 18, suggesting stocks were significantly overvalued. Conversely, in the 1980s, this ratio plummeted below 1, indicating gold's massive appreciation or stock's relative undervaluation. The peaks and troughs of this ratio provide a roadmap of economic sentiments. During times of bullish stock market sentiments, the ratio rises, implying that stocks are outpacing gold in value. Conversely, during bear markets or times of economic uncertainty, investors flock to gold as a safe haven, pushing the ratio down. At different points in history, the ratio's value has fluctuated dramatically. A high ratio can indicate that stocks are overvalued, while a low ratio suggests the opposite. However, a continuously falling Dow-Gold ratio, even in the face of a seemingly booming stock market, hints at an underlying trend. Stocks might be losing real value when contrasted with gold. Gold's allure isn't just its physical brilliance. Historically, it's been a bedrock of economic stability. As fiat currencies are subject to inflation, and consequently, a potential loss of purchasing power, gold has historically offered a hedge against such economic vulnerabilities. Throughout human history, from ancient empires to our current age, gold's value has remained relatively consistent. Recent market trends have shown periods where, despite the Dow Jones Index rising in USD terms, it has effectively been on a downtrend when priced in gold. Such a phenomenon isn't merely an academic curiosity. It has tangible implications for investors. It suggests that in real terms, when accounting for gold's stability, the market might not be as robust as nominal dollar figures suggest. Several macroeconomic and geopolitical factors can influence this ratio. Central banks worldwide have adopted policies of quantitative easing, often leading to increased money supply. Such measures can inflate stock prices, pushing up the Dow, while simultaneously devaluing fiat currencies, bolstering gold's appeal. Furthermore, geopolitical tensions and looming economic uncertainties, such as global recessions or escalating debt, can influence investor behavior. During tumultuous times, the intrinsic value of gold often shines brighter, leading to a surge in its price and a potential drop in the Dow-Gold ratio. Like all financial metrics, the Dow-Gold ratio isn't without its critics. Some argue that it oversimplifies a complex economic landscape. Moreover, with the increasing influence of assets like real estate, tech startups, and cryptocurrencies, there are questions about whether gold remains the most representative counterpoint to stocks. For modern investors, the Dow-Gold ratio serves as a reminder of the importance of diversified portfolios. Relying solely on traditional stock indices might paint an incomplete picture. By incorporating assets like gold, investors can hedge against unseen vulnerabilities in the market, ensuring that their wealth is preserved even in the face of stock market declines as depicted by the Dow-Gold ratio. While the Dow-Gold ratio might not be a daily talking point for most investors, its significance is undeniable. It provides an alternative, historically informed lens through which one can assess the stock market's health. As we move into an era of increasing economic complexities, tools like the Dow-Gold ratio will